one. How far was speculation responsible for the Wall Street crash? The Wall Street crash in 1929 was a devastating day to the stock market and the US economy, which led to the Great Depression. Speculation was a key reason why the economy and stock market crashed in 1929, but was followed by several other main reasons such as the weakness in the US economy. Speculation was mainly focused on confidence. Investors would speculate and buy stock on margin to make quick profits that created the real value of the company less than the value of the shares, which led to the bubble. Investors borrowed money from banks so they could buy more shares and then sell them for a quick profit. There were more share buyers than sellers, and the value of shares was rising rapidly. Due to the banks lending out money because they thought that they would definitely pay back along with interest because they would buy shares, but because banks loaned out so much money, 500 banks failed and was wiped out each year! Exclamation mark! October 29th, 1929, it was clear to the speculators that the banks were not going to intervene to support the prices of shares. So Wall Street had its busiest and worst day in history. Speculators dumped 13 million shares at a fraction of the price they had paid for. Speculation was connected with the weaknesses of the economy. The construction industry had its downturn as far back as 1926. Farming was already in trouble and suffering from the boom along with the decline of coal, textile, and other traditional businesses and trades. One key reason linking with speculation was the unequal distribution of wealth. Shoeshine boys would invest in the stock market because it was a very easy and simple thing to make money. They would buy into companies they know nothing about, which slowly destroyed the market, leading to the crash. Car sales were even slowing in June 1929. The official figures of industrial output showed a fall for the first time in 4 years. That means that the rich people, which is 5% of the US, already owned cars and had no use for buying another. Middle class and lower people could afford cars, they all bought shares eventually. These causes slowly led up to the crash of 1929. Therefore, it was not only speculation that caused the Wall Street to crash. The US economy was already beginning to fall in the 1920s due to the state of banks, unequal distribution of wealth, and farming, coal, textile industry slowly dying out. Even before people began speculating on the stock market, the economy was going to fail. They didn't know. It was finally reaching its peak.